Hi, Michael Glennon from Glennon Capital. Today I'm going to talk about a very interesting company called Swift Networks. So it's a microcap. It's got a $60 million market cap, so right down at the smaller end of where we tend to invest. And what Swift is, it's a provider of digital content. So it'll provide content into things like the resource sector, aged care facilities, student accommodation, and it's starting to venture into sort of offshore marine sector. So anywhere that's sort of a remote sector that has struggles getting normal entertainment systems or internet or phone systems, that's where they operate. So how Swift earns their money is that they charge their client per room per month for the content that they provide. So it's a fixed fee. And then how their client recoups that money is then they then charge their workers for the content that's downloaded. So the worker or the patient in a sort of aged care facility, they can then choose how much of that service they want, whether they want to get mobile internet, whether they just want to have an entertainment package. And that's how the money's recouped. So it's sort of a similar to the Foxtel model here. You pay and you use your content, you've got on-demand content if you want it. They're just about to add to that business model by providing targeted advertising. So if it's into the education sector, they'll provide advertising that's relevant to the education sector. If it's sort of got older male workers, they'll provide content that's relevant to those people. So they think that that will match their existing earnings in 2 or 3 years' time. So that's quite an attractive opportunity for them. And the other thing they've done has been very strategic in terms of sourcing their content. So they go to global content providers, whether it's movie studios, and they source the rights to the content, and they only pay for that content once the content's been downloaded. So the benefit of this system is that all of the content sits on Swift's network, so it's not being downloaded from the internet all of the time. So at any one site, one piece of content can be downloaded or can be viewed up to 3,000 times at one point in time. So 3,000 simultaneous views of one single piece of content. So it's very leverageable business model per site. And you think, that's if you had 3,000 people watching that one bit of content. Of course, people are all watching different bits of content. So you can have huge scale in this model. You're not relying on huge data because it is in regional areas and offshore oil platforms and things like that. So very attractive economics in terms of the infrastructure that's needed by Swift. And it's a good model for resource companies to put into their sites to be able to attract workers because they've got, very fast internet and great movie content. It also provides in some of these facilities additional services like, menus for food, transportation, if you're on a mining site, when planes are coming in and out and things like that, and, various other, emergency systems or things like that. So it's a general sort of announcement system as well. They generate about 200 million unique views per year, and they're installed in about 340 sites at the moment. They are the dominant player in the resource sector, and they're only emerging in the aged care sector, where the alternative in the aged care sector currently is either Foxtel or free-to-air television, which, due to the changing sort of metrics in free-to-air is less attractive than having paid for content, and is on demand. So that's also a huge shift in what's happening in terms of delivery of content. They are small in that student accommodation and maritime sector, but that's an opportunity for growth for them, one of the things that we're quite optimistic about. And in terms of the overall business, that revenue base, 72% of that's recurring, and 25% of the content that's on their platform is refreshed every quarter. So there's always new content. It's not stagnant, stale, old movies that are being delivered. There's always something new for workers to watch. 43% of their sales, so the total sales for Swift, come from content providers, people like Telstra, who are actually offering their services to their clients as part of a package. And Swift's also a reseller of Foxtel, so there's nothing that they're not mixing out with. So Foxtel's probably the major competitor, but they can also offer the Foxtel package. The balance sheet's clean, there's no debt, and cash flow generation is very solid. They pay for the content in arrears, and they pay their bills in advance. So, we like the metric of that in terms of working capital. In terms of pricing and PE multiples, it looks expensive, and that can happen with microcaps quite often, but massive leverage in the bottom line because they do have a relatively fixed cost base. So, for example, 2017 financial year, they generated $1 million EBITDA. 2018, that's grown to 2.7 million, so massive percentage increase, and that's the type of leverage that we're looking for in some of these small companies. So we're quite optimistic about this business. Margins have increased from 32% to 42%, and we expect them to continue to increase over time. So a very attractive business model, interesting small company. It's one to watch. I'm Michael Glennon. Thank you.